Hi, everyone. Thanks for joining us today. I'm really happy to be here with all of these amazing guests. Um, just very quickly introducing myself. My name is Adriele, but for all of those who are non Portuguese speakers, you can call me Audrey. I'm based in Brazil. I am the LatAm Sales Director for Utila. And just for context, Utila is a digital assets platform. We currently serve fintechs, any companies that are looking to start in the stablecoins environment. And I'm very happy to be here with the guests. So maybe for a few minutes, very quickly, because I know I want to be conscious of time and we have so many people here. Maybe we can start with the introductions of each other. So Max, can you start?
Sure, Max, co-founder of Iron, now part of MoonPay, doing stablecoin payment infrastructure.
Thank you. Paula?
Hi, Paula, VP of Strategy and Growth at Range, where we do compliance, risk, and intelligence for our stablecoins.
Great. Luis?
Yes, I'm Luis, Chief of Staff at AllUnity, and we're building the first BaFin regulated Euro stablecoin.
Thank you. Josh?
Hey, I'm Josh. I'm COO at TGBP, or Tokenized GBP, and we're the only live GBP stablecoin issued by a UK-based company.
Great. And last but not least, Mark?
Hey everyone, apologies for being a couple minutes late, technical difficulties. I'm Mark with YellowCard. I'm B2B Marketing Director. And yeah, with one of the largest stablecoin infrastructure providers across Africa and the emerging markets.
Perfect. Thank you, everyone. And I think we're good to get started. This is our third episode of the Stablecoins webinar series. You should expect more episodes to come at least once a month. And today we're going to be talking about the rise of non-USD stablecoins. So we're going to touch on topics like infrastructure, adoption, opportunities, and then I want to save some time for questions at the end. But we're here, and the goal is to, just to have an informal conversations and get each one point of view on that. So to get things started, I would love if we can talk about some of the non-USD stablecoin cases today. So maybe Louise, you can start, and then Josh, you can go after. So what are some of the concrete use cases and macro drivers that are driving demand for non-USD stablecoins?
Yeah. So first of all, it's not crypto. So it's really the real world use cases. So bringing the euro on a global level so that you can do supply chain finance, etc. So really paying invoices when you have a counterpart in Latin America and Australia or Singapore. And this is really like for SMEs, so small, medium enterprises that need fast rails to make payments on an instant level, I would say. And within Europe, yes, there will be a digital euro down the road from the European Central Bank, but this one is also not yet there, and we also don't know when it will come. And within Europe, it can be also used to bypass MasterCard and Visa, so that you have like a direct account-to-account payment ecosystem. And that's where we also position ourselves to build more or less a European payment infrastructure where you can settle account to account, either it's B2B or in the retail sector.
Perfect. Thank you. And Josh, anything you want to add as well?
Yeah, I'd echo a lot of what Lewis said. Really, the big one from the B2B and kind of institutional side is FX and cross-border payments. But also, I think a little bit within crypto, even though kind of the UK and the EU do get ragged on at the left this week, there are a lot of great companies that are built here. And traditionally, a lot of Web3 companies have just held their treasuries in USDC or USDC yielding products or denominated products. So I think that's moving forward, going into like Euro stable coins and of course GBP stable coins like we're building. And even on the retail side, as you build these yield products or crypto-backed loan products, or eventually even, let's say, RWA loan products, so that could be tokenized stocks, those will need to serve the biggest markets that a lot of these crypto exchanges and neobanks go after. the UK, Europe, Australia, Singapore being a lot of them, and that's kind of where you're seeing a lot of these non-USD stablecoins growing right now.
Yeah, yeah. And Max, moving to you now. So where do you think we are still seeing theory versus reality gaps?
Liquidity, I think, is one of them, right? So the most important thing for us, like in the payment world, is very much liquidity. I mean, I often say that stablecoins really are not currencies yet, like they're transfer agents between real-time payment networks, right? So if you look at kind of PIX, SEPA, UPI, at some point the US will also have real-time payments like FedNow, etc. Like you just need a connective tissue between different systems, right? And that's where you go for the most liquid version. Doesn't really matter which currency it is in, right? Because technically you don't hold this asset for a long time. So I think, payments for now actually don't require localized versions of stablecoins, but they will come over time, right? Like, I mean, there's, at some point, like when the recipient is able to actually hold a local currency version of a stablecoin, you kind of save one hop, right? And that's an important one, right? So it'll come, but I think we're right now have a lot of pains to solve when it comes to actually large cross-border B2B money movements, and that's where you go for the lowest cost stablecoin, which is the most ubiquitous in acceptance, and that's typically US dollar ones.
Yeah, exactly. And Paula, quick add up here. So what are the top 3 dominated non-USD stablecoins today?
I mean, from my point of view, it'd probably be like the Euro ones. I mean, right now, the USD ones are taking, most of the space exponentially, but I think there's a lot of growth in the non-USD stablecoins for the reasons that were already spoken of as far as FX and cross-border payments. So we are seeing a lot of growth on the Euro stablecoin side. So even, we spoke to AllUnity earlier today. So we have AllUnity, we have SG Forge, we have a lot of these banks on the Euro side that are coming out with very, real Euro stablecoin contenders. So that's some of the main ones that I have been watching. But we'll be seeing how they converge or how they evolve over the next coming years.
Yeah, I think this year is going to be very interesting, especially with regulations coming up and newer use cases. So let's see. And now changing a little bit more for infrastructure and some distribution challenges topic. So Mark, can you tell us what do you think are some of the biggest infrastructure or liquidity hurdles that non-USD stablecoins face compared to regular USD stablecoins?
Yeah, I mean, following on from what everyone said, it's kind of this chicken and egg problem that we're facing, right? Market makers they won't provide liquidity without volume, right? And users won't trade without the liquidity. So I think that's a challenge that's being faced. I mean, I think I'm also bringing in, I guess, an African perspective here, and in the African context, the fiat on ramp is also incredibly important, right? So if a Nigerian user can't easily convert their naira into a naira stablecoin because banks have blocked crypto rails, or then essentially that stablecoin is going to die, and a lot is being there's a lot of reliance on P2P networks at the moment, and that's that needs to change, I think, for us to see more growth.
Yeah, that's very interesting. And Josh, Mark touched on some of the African region. Is there anything you want to add focused on Europe?
No, I'd echo the same thing on liquidity. It's hard being, I guess, a vanilla or fiat-backed stablecoin, especially when you look at a lot of the US dollar stablecoins and the algorithmic ones. They do have a native token that you can use to incentivize liquidity. And generally, these projects are paying sometimes upwards of 20% to bring that liquidity on chain, whereas you just can't do that when your reserve backing assets are probably paying 3 to, let's say, 5%. But on that, I think what Mark said, like how do we get this liquidity there? I would say there has been probably like a fundamental shift in just like the market cycle, and a lot of these chains are looking to kind of be the chain where non-USD stablecoins live, or this cross-border payments or FX payments live. I think Polygon did their like open payment stack recently. There's a lot. Yeah, Base is also looking, I think, at Token 2049. Jesse said that's something that they're really looking to power is non-USD stables. So I think that liquidity will come from people that realize how big of an opportunity it is. And then once that liquidity comes, then hopefully, yeah, the volume follows.
Yeah, yeah. And Max, Josh just mentioned a few companies and things that they are doing. What do you think, on your vision, companies will need to do to overcome these barriers as well?
Which barriers? You mean basically the on-ramp barriers, or which specifically?
The distribution challenges.
Yeah, I mean, I think like global payouts is actually decently solved, I would say, right? Like if you want to go from stablecoin into global payouts, it's something that you have a lot of vendors to pick from. You know, you have like the local, you know, the Tunes, the Tazapays of the world, and like there are just many like aggregators, etc., that solve this. So I think the hardest part is the local on-ramps. So local collections is something I keep hearing that needs solving, and there's a classic issue here, which is capital controls across the world. Like, you know, a lot of emerging markets have those, so it's pretty complex to actually get money on chain. And you know, typically you need both, like first on ramp and then off ramp in another country. So that's certainly something that we see a lot, or a lot of requests for. Can you help us, like, you know, with the on ramp portion in several emerging markets? And that's tough, right? So that's sort of one thing which needs to be fixed. You know, the other thing in general is cost, right? Because obviously, you know, speed is something that stablecoins do extremely well, right? But you still have like a pretty limited set of banks that actually are able and willing to work with, you know, anything like crypto related, right? So, and you know, you saw before, like JP Morgan actually cut Checkbook, you know, due to all the issues they had with, you know, I think it was ACH reversals, or like a lot of things that happened there, right? So that's the thing, right? Like there's still like a pretty big bottleneck when it comes to, you know, like high performance like channels, like with high liquidity and enterprise grade banking rails to make that work. So this is actually something that Iron is putting a lot of focus on, like to actually have on a per region basis, like a very deep banking network stack, such that, you know, in case of when something doesn't work, like you can easily replace. And this is something that it's, you know, costly to build, complex to build, but it's very needed. I think it'll get easier over time when more and more banks come on, and like they're happier to actually work with the crypto vertical. And I think there's still like you know, a misconception of, in terms of risk, what actually stablecoins entail. But yeah, this is something we kind of collectively have to work on and do a lot of lobbying around. And it'll take a couple of years, but we'll get there.
Yeah, that's true. And Paula, now to you. Do you think we're building too many non-USD stablecoins, or is fragmentation an avoidable phase of early adoption?
Yeah, I think fragmentation, or you know, contenders, competition, it's always good for innovation. So I think it's good that many people are getting in right now, trying it out, learning things, making it more of a topic. However, long term, I don't think it'll be feasible for us to have this many. Not everyone can have their own stablecoin. Just like we saw, you know, early .com bubble with search engines, everything. It will have to converge to maybe 2 or 3 primary ones, or at least per region, just because, you know, the fungibility between each token. If we can't be sending in between euro stablecoins and having, you know, each bank have its different way that it's managed and the liquidity managed different, and we can't make the new version of stablecoins more complex than the current existing financial model. So we will see it converge, but I think it's good for now for healthy competition and innovation.
True. And Luis, I see you're nodding a lot. Anything you want to add to that as well?
I just want to add on Max's point regarding that we need it in emerging markets, but what we see heavily, especially also here in Europe, is that it's also like in big markets like Germany or in general Europe, it's still a big pain point, the on-ramp, because nobody understands how it works. And that's why we're pushing really hard to talk to the banks, integrating wallets with banks, etc., that you have like an easy on-ramp, because in the end, for a treasurer with gray hairs, it's still like a new topic, and they have a huge issue still in the existing world, and they can't move fast. So the main goal, what we also at AllUnity have, is that we build more or less a one-stop shop with good partners that we can just say to a big car manufacturer, for example, look, here is the ready-to-use solution, and you can use it with your Deutsche Bank or Commerzbank bank account right away. And that you can then simply do your treasury, for example, with SAP. And that's the key. So we have to more or less build an A to Z solution. And that's also for example, in Europe, the biggest issue still. So it's not the blood in the world, I would say. So that the Euro stable coins, it's really the infrastructure problem.
Perfect. And I do want to move forward, but I think this is a very interesting point. So I just want to ask Mark, how do you see that on the African side of the non-USD stablecoins?
I think I agree largely with what Paula said as well. We're going to see a lot of these stablecoins initially, and then it's going to converge to a few. We've had some significant regulatory advancements on the continent. South Africa, followed now by Kenya, Ghana. And so with that clarity, I think we're going to see sort of more of these local currency stablecoins being issued, which is a good thing. And then in time, it'll be consolidated. We'll get a few winners, and that's that's where I think we'll see most of the volumes move through. So
yeah, that's right. And still on regulation and compliance, Josh, this is to you, and then interested on Max and Luis's point of view as well. So, do you think that with frameworks like MiCA and Audrey, does regulation meaningfully accelerate adoption of Euro and other non-USD stablecoins, or do you think it risks slowing innovation?
Generally, I think it accelerates it. I don't think we'd all be able to have the conversations we have with large institutions, banks, and the big players that we're now going after without regulation and these frameworks in place. I'd say from the GBP side, there not being the full regulation in place has kind of given us a privileged position where we are the only FCA registered company that has issued a GBP stablecoin through the regulatory sandbox. But I'm sure once full regulation does come in, there will be competition, and we welcome it. But yeah, there are downsides in terms of like how many competitors there are in Europe, but then there's also the upside that once you kind of do all the work that especially like AllUnity's done, you're really able to go after these like big institutions and get those and win those customers.
Luis, anything you want to add?
No, I totally agree. So the only thing with the regulation is that on the one hand, it's that even that the companies that they are motivated to use stablecoins on the one hand, but still, especially with MiCA and as in Europe, stablecoins are tokenized e-money. We are double regulated, and that's also a little bit a problem because when we would be just e-money, then it would be easy because then it would be cash equivalent. But now with also be fully regulated under MiCA, you're crypto on the same side. So a treasurer can't use us really for payments. And that's still something what we now have to figure out in Europe and what we have to be aware, like on a global scale, that this is not happen, I would say, in other jurisdictions, because in the end, what we have to achieve with stable coins is that they are cash equivalent, because otherwise a big treasurer who is like moving billions daily can't use a stable coin because it's not cash equivalent. So from the risk exposure, it's not possible, and they still have to rely on traditional banking rates. So on the one side, it's a win, but on the other side, it's also like, we have to see where it goes. But I think especially, we here in Europe now have to tackle this issue and getting it done that, tokenized e-money is really cash and can be used for global payments.
Thank you. Mark, so this question to you. In emerging markets, when do you think it makes more sense to use a non-USD stablecoin instead of dollar-based one?
Yeah, I think the rule of thumb is use the USD stablecoins, at least in Africa, for a lot of savings and hedging, and ideally we'd want to use the local stablecoins for transaction flows, right? Like using USDT for local B2B payments, it does create a lot of sort of tax headaches. There's FX risk at the moment of settlement. So if I'm a South African retailer who's importing goods, say from Kenya or somewhere else on the continent, we're currently settling in USD. If we had liquid, South African stablecoin like the ZARP, and then we have the counterpart there in CKES, we could settle directly via an on-chain sort of on-chain FX pool, and that bypasses the dollar squeeze, and you can get a couple percentage points of savings there. So I think that's one that I see.
Perfect. Paula, anything you want to add?
I mostly echo, what Mark said. And when it makes sense to not pay additional fees or taxes, or just general stability of a local currency, having it in USD makes sense. But for some of the more local transactions, it does make sense for, the user, especially a retail user, to maybe use their own currency, or, in a cross-border payment, if a user's coming from even just say euro to USD, to pay in the euro and receive in the USD, just like traditional cross-border payments occur. So in those instances, it would be a good experience for the retail user to use their locally denominated currency.
Perfect. So still on use cases, but changing a little bit the focus. Max, what do you think are the primarily payments to today? Do you think is it treasury, hedging, yield cases are catching up for non-USD?
I mean, first of all, like the prime use is still crypto trading and kind of hedging, not hedging, but like kind of moving funds between crypto exchanges, right? That's the main use how kind of stablecoins are used today. And market makers, exchanges, institutions, I think it's like 80% plus of that flow is actually to kind of rebalance books across market makers and exchanges, right? But I wouldn't really classify that as payments, right? So I don't know how much of that residual 20% is true payments, right? But probably a good portion of it. And the majority here is, classic cross-border payments, remittances, B2B flow, mainly actually B2B flow, where, companies run treasuries and kind of do cross-border settlement. PSPs need to hedge between their individual country books and move funds. And also payroll starts to increasingly become a use case, right? So these are the typical ones. And, I think retail is still very small. And because you don't typically have kind of strong retail flow, like C2C from country A to country B, it's mainly B2B flow, that moves the needle. And I think also when you look at the classic FX just flows, it's just predominantly, I don't know what the percentage is, but very, very, very high on the B2B side. And that's kind of what's being replicated also here on the on-chain world.
Great. Josh, anything you want to add?
No, I'd again echo what Max said. I'd say maybe even 99% B2B when it comes to FX flows. I think I'd like to see more retail, and I think YellowCard is another one that's doing some retail payments there. There's some new ones as well. I think like Sling Money. There's a lot kind of going from especially the UK to Nigeria and Africa, and even India, when you have a lot of immigrants and these remittance flows. But from a nominal percentage, it's still very small. I think one way that retail can grow is not maybe on the FX payments, but more on this kind of RWA side, whether that be into tokenized equities, tokenized bonds, or crypto-backed loans. You can kind of see the exchanges really want to recreate I guess what you saw in the 2021 cycle, like Celsius and BlockFi, as bad as that turned out, they actually were very big businesses. They just weren't done the right way. But now you see Coinbase kind of recreating that with Morpho. So now, of course, I think they've originated over $1 billion of loans in the US. So the next phase of that is really, okay, let's go to the other markets where these products were popular. And that's usually the UK, Europe, Australia, Singapore. And you can see that's where the success has really been in non-USD stablecoins. From a retail perspective, at least, yeah.
Yeah. And Paula, so on the retail perspective, just interested in hearing your thoughts and opinions of what do you think it's going to take for this segment to grow as well? Kind of touching on what Josh mentioned.
Yeah, so we'll definitely have to improve kind of all the B2B aspects, you know, the liquidity, everything on those aspects. But then for the true retail users to come in, we'll need to have kind of, this business adoption and then just really clean UIs. So people being able to use it from their bank account, being able to fiat on-ramp or on-ramp in, and also at the end of the day, mostly not see it. At the end of the day, it just needs to be a payment to them. The easiest payment that has the best fee, that goes the quickest, and maybe, maybe they see a little thing that says it's in stablecoin. Maybe they don't, but it just needs to be it needs to be the easiest and simplest solution, and that means options, liquidity, integrations into banks, and just general availability.
Great. Perfect. So
just to add to that, if you don't mind, like I just had a thought. I mean, I think in Africa, mobile money is going to be very interesting to watch in the coming years. It's a huge market. I think over 750 million sort of Africans using mobile money, and I think there's an opportunity for these mobile money providers, Safaricom, M-Pesa, and the likes, already announcing that they're going to be moving into the blockchain space. I think that presents an opportunity because ultimately, I mean, a lot of these, mobile money in many ways has a lot of similarities to local currency stablecoins. So I think that's an opportunity to see some mass adoption and proliferation with some of these big players on the African continent.
And Mark, I'm gonna continue the topic with you, settle on it. I want to hear your thoughts on if you think we are underestimating the role of stablecoin orchestration and routing versus the issuance itself.
Yeah, I mean, I guess as working for an orchestration company, I may be biased in that regard. I think it's really critical, the orchestration piece. I mean, at YellowCard at present, I think we're seeing about 10% of our volumes are actually in euro denominated stablecoins, and I think it comes down to like the use case. I mean, in our instance, it's the Francophone Africa to Europe rail that is really critical. We've got a lot of businesses making payments in that area, and they don't necessarily want to hop to dollar and then, or from local currency to dollar and then back and then again to the euro. And because we facilitate that, those savings, allowing them to move from the ZAF or ZAF currency to the euro stablecoin, we've seen sort of really organic growth. So the orchestration piece is, I think really, really critical.
Yeah, that was not an accident that I asked you that. So, so now to Max.
I wanted to actually say something about orchestration as well. I mean, I think there's two types of orchestration, right? You have fiat orchestration, you have on-chain orchestration, right? So I think the latter will be increasingly more important the more stablecoins are being used, right? So obviously the fiat orchestration is you just have a lot of banks under the hood, and a lot of currencies under the hood, and you're helping to go from fiat into on-chain money. And that's super critical right now, because that's still a very unsolved problem at scale, right? Like, there's a lot of fiat orchestrators out there, but a lot of them break once you hit enterprise scale flows. So that's a really important one. And ideally you go direct to bank. You pick a vendor that has direct banking relationships, is licensed themselves. Iron is, MoonPay is, right? But like there's still, I think, a problem on the like if you're a vendor, like actually someone looking for a fiat orchestrator, it's very difficult to actually find out who to pick, who has kind of a very resilient rail. And a lot of them say the same thing. Oh yeah, we do on-ramps in X number of currencies, and we support these and these rails. But then you have to go deep and ask and actually figure out, like, what relationships do you have? Like, is this actually your own rail, or are you utilizing someone else? And is that someone else usually someone else again, right? Like, and then you start to have that layer cake, and then it might work, but then you have one failed transaction, and you have to go through the entire ladder of vendors that are being used, and that is a big problem. So fiat orchestration, like literally with bare metal rails directly to bank, and there's not many vendors out there. So that's something we really specialize in. But like now, the next step is obviously on-chain orchestration when it comes to, I want to deposit any stablecoin on any chain, and want that platform that you deposit to actually receive it in either their own custom stablecoin. So we do, for example, custom stablecoin issuance as well. But important thing is that you're able to ingest a whole bunch of currencies and stablecoins and even crypto assets and turn them into what the recipient stablecoin is. And that's on-chain orchestration, right? That's also difficult because there's a whole set of different problems here. You need know your transaction, on-chain compliance, and there's a lot of things there that need to be done right. So, and I would really separate these two things, and they're right now they're equal importance, but over time, I think the on-chain orchestration piece will become even more important. The more people are happy to actually stay on-chain with their entire flow of funds.
That's very interesting. Anything else you guys want to add on this topic? No? Good. So I want to ask Josh about some sort of non-USD stablecoins experience. So when supporting multiple non-USD stablecoins, what do you think it breaks first when it comes to the production itself? User experience, FX pricing, treasury operations?
Yeah, what breaks first, or I guess probably the biggest challenge, I think, is liquidity, like we spoke about earlier. One thing I think I'd like to see the space in general really that can invest in more is probably a lot of these like liquidity operations. I think there was an article about non-USD stablecoins recently. I can't remember who it was by, but just showing like even though there's, let's say, over 100 million in liquidity from let's say Euro CV or a lot of these other Euro stablecoins, sometimes within 10 bips, there's only 1K of liquidity. And actually just going from Euro to USDC OTC, that'll usually be 10 bips depending on what your rate is through wherever your OTC desk is. So yeah, I think that's still the point that's breaking. But I think that'll get better over time. I think a lot of from a lot of these corridors as well, I think you'll see partnerships which allow issuers to be a bit more efficient. So you don't have to kind of just always go through USDC. So maybe it's TGBP, Euro AU instead. So you don't have to go through USDC on both sides. But yeah, I think it's a challenge, but something that I think will get solved over the next few months.
And we're talking about breaking points, but now, Paula, which metrics do you think that actually prove that a non-USD stablecoin is working, and which are some of the other signs that you think are going to be misleading in that? So maybe we start with the optimist part.
Yeah, I think amount of holders, volume, obviously liquidity, how much it's being used on different applications. I think those are all signs of a healthy, well-utilized stablecoin. I think signs of one that maybe still has a lot of space to grow or is maybe much earlier is probably quite a bit of consolidation. If there's certain wallets that hold major portions of the token and not that much volume or integration into different applications, that's not to say it's a bad stablecoin. It's just maybe a new stablecoin, and there's a lot that it needs to grow to get general adoption. But I mean, I'd say probably the biggest indicator for me is just who's holding these tokens, and is it diverse?
And Max, what about your thoughts?
Liquidity. It's basically all about that, right? Because in the end,
Yeah.
like if it's deeply liquid, it shows that like there are a lot of like market makers either interested in it, or you have deep pockets backing it, and then typically you also have acceptance at a lot of venues, a lot of layers, right? And obviously non-US dollar stables have liquidity as their biggest problem today, right? So that is the number one indicator for me to take it serious, to integrate it, to look at it. Also developer experience in a way, right? Like how easy is it for us to hook up to minting engines? How responsive is the team? But that's sort of second order effects. If liquidity is not there, we don't even have to look at it.
Great. And I want to touch this one to Mark. Changing the topics a little bit, how do you see what do you see some of the biggest challenge for institutional adoptions? We spoke a little bit about liquidity, compliance, and use cases, but interesting to hear your point of view now.
Yeah, I mean, I think those are the big ones. I mean, I think when we talk to institutions, some of the first questions that come up are around regulation, right? I mean, the big players want to know if there's a framework for what we're doing. We get a lot of questions around tax implications and the likes, and that's why I think with regulation, although regulation like MiCA and the FSC, what the FSCA is doing in South Africa, etc., some may argue that it creates a hurdle for the smaller players to get involved, and that's absolutely true. But what it does on the other side is it makes it comfortable for large institutional players to enter the space, and I think in the long run that's going to be beneficial for the whole industry. So yeah.
And Luis, what do you think?
Yeah, I totally agree with Mark. So from our side, it's also connected to the liquidity issue and all these kind of stuff. It's also in the direction of finding the, I would say, real world use case, especially for non-US dollar stablecoins outside of crypto, because what also is happening, why there is no liquidity, is because always corporates are most of the time stuck, because when they say, yes, we are stablecoin ready, we can do stablecoin payments, the counterparty is not able to receive or send stablecoins. And that's something what we also now always have when we getting or corporate is asking us, hey, I want to use stablecoins, and we always say like, look, yes, you can use them, but is your counterparty also in the position to send and receive stablecoins? So it's always currently the biggest problem that you always have to think about, okay, what is then the end goal? So where does the flying wheel start? And that's like where you then also have to think about, okay, when you have like a supply chain finance setup where you want to pay invoices on stablecoins, then this should be not the end story, because then you have to also think about, okay, where does the liquidity comes from the beginning? And that's why we always make the example, for example, when you have the flow from A to Z with a Coca-Cola, the Coca-Cola gets bought in the supermarket. So the starting point has to be in the supermarket, that you can pay there with, for example, a Euro AU, pay your Coca-Cola, and then this Euro AU can be also used for the producer of the Coca-Cola bottle. And that's more or less how you have to, or how we have to now structure the market, that you have there a flow that is really like going in a flying wheel direction.
Perfect. Thank you. So we get to the last question, and this one is for everybody. So the question is, in the next 24 months, so in the next couple of years, what would success for non-USD stablecoins actually look like? Josh, do you want to start?
Yeah, it's a good question. I can't remember what the percentage, I think, of actual like trade flows or actual currencies that non-USD current fiat currencies is. I think it's maybe 20-30%. So just seeing that as the actual market cap of stablecoins versus US dollar stablecoins, was right now I think it's 1, or is it not even maybe 1% or 3%. So yeah, 10x growth I think in 24 months would be the ideal place where we want to get to in terms of market cap and volumes.
Perfect. And guys, feel free to share your internal opinion. Don't need to base in numbers. We want to hear your thoughts as well. Paula, what do you think?
Well, yeah, I 100% agree with Josh. When we were doing our report on non-USD, yeah, the percentage of the market cap I do believe was less than 1%, around there. But there's so much room to grow. It's not everything can or should be USD denominated. So I think seeing that, 10-20x growth to at least maybe 10-20% market share, I think that'd be a great success for the non-USD stablecoins.
Luis?
Yeah, totally agree. I mean, we are a stablecoin issuer, so we have to say it's even more, because I think when we make it this year that the infrastructure is working, what I mean by that is that really banks offering wallets, then we have the IRANs, the bridges, and so on in the world. And then, for example, when also now Stripe and the Tempo blockchain goes really live, then we have like this A to Z flow, what I mentioned before, and then we think it getting pretty fast that especially Euro stablecoins will go through the roof, because then you have this engine where you can send the funds around. Also, for example, with SAP, with their digital currency hub. I know it's in the talks since years, but now they are soonish fully live. And once big corporates starting to use stablecoins, then you have by overnight 1 billion, 2 billion in flows in Euro stablecoins, and then there's the bottleneck, and then once you push this one, it's a flying wheel. So I'm very confident, but it's all right, I would say around now 2026 to build this infrastructure that we are able to move the funds on chain.
Max, what do you think success will look like in the next few
So I
years?
think if we have like a couple of strong winners in each region, that would help, right? So if you have 1 or 2 strong Euro stablecoins, BRL stablecoins, MXN stablecoins, etc., like alternatives we can actually use. I don't really want to look at it in terms of comparison versus US dollar stables, because like we're talking, potentially trillions in issuance. Like at least that's sort of where the market is headed, or what we're looking at, right? But we don't necessarily even need the 10% mark, right? Like we just need like a decent liquidity in local rails to ensure that we can use them and kind of embed them into our operational flows, kind of saving one hop. And like if that's achieved, like I think we're all looking to a bright future. And I think also like that they are around, right? Like I mean, it's like they're all like commercial businesses, right? Which means like there's runways, and like these companies have to make money and raise capital to be able to be around, right? So I think, for us, it's a win. Like if we have actually a very strong, flourishing ecosystem, it's very diverse, even like, exchanges where you can trade them, like dedicated FX exchanges with decently deep liquidity. All of this, big win. And then just, from there on, it's just up.
Thank you. And Mark?
Yeah, I think probably, I echo everything that everyone said. Consolidation, integration. I think large B2B volumes. But as I said, from an African context, I think there's a big opportunity to see what happens in the next 18 months with the big mobile money players, if they sort of move into the space in in a serious way, it could show a lot of growth. I mean, in Africa, I think maybe the most compelling case for local currency stablecoins is with intra Africa trade. I think the continent spends like something like $5 billion or something on intermediary fees, with countries just trading with one another. So if there was, FX infrastructure that's powered by local stablecoins, that could really shift significantly a lot of these trades to happen between these local currency stablecoins. I mean, it's a big hope, big dream, but that would be fantastic.
Yeah, and I just want to add to everyone's point that for me personally, success for stablecoins would mean more people talking about it, more people. Like we burst the bubble of everything we know when it comes to USD, then we have more people talking about it. We see more inclusion in it. But yeah, we don't know the future, so let's see. Guys, I had saved this 10 less minutes for Q&A, but we had a small technical issue, so we are unable to get the questions here. So we still have some time. I just want to ask if anyone wants to add anything, something that you didn't get a chance to speak or to share with the team?
Yeah, I think one thing, we're seeing like an emergent layer for synthetic stablecoins, like sort of hedged US dollar versions, like basically US dollar, but hedged to like other currencies, right? And there are a couple of like protocols out there that start doing that. I'm pretty curious to see where that's going, right? Because let's say you're building a B2B focused neobank, right? Treasury focused, right? Like, and then you kind of can already say, hey, I have my USDC or USDT there, and then, but they're just kind of currency hedged to Euro, SGD, and you can literally like cover the entire globe, right? Because like these currency hedging, the volume just goes very deep, right? The liquidities, which means that you could instantly have a pretty deep, like global base of like synthetic stablecoins as an API, backed by existing US dollar stables. Pretty curious whether that's like a big threat or an opportunity. I think it's an opportunity because you would probably still need like local versions of stablecoins for, tokenized RWAs that need the cash lag directly in the local currency. But I think that's actually an interesting thing that's not really discussed a lot, that you could technically achieve the same thing. If you're all about currency risk, you can do this in a different way. You can hedge it, right? But yeah, I mean, it's very nascent, very early, and we're looking at it, but just wanted to know whether this is something others are seeing too.
Louise, Josh?
Yeah,
Paula, Mark, obviously.
Totally agree. Especially what we also see there is that yes, against US dollars, interesting, but I think what is even more interesting is to hedge against euro or even a Swiss franc, because it's a way more stable currency, and that's where we're also looking into to see like, okay, how can we build this, especially regarding this always topic, European sovereignty, to push the euro on a global scale that it's used for hedging. And on top of that, what we also look into is how you can connect with other local stablecoins, that you can also say like, look, we have here AllUnity Euro. On the other side, we have a Mexican peso stablecoin, MXMB, for example, and how you can really make their efficient rails end to end with currency hedging somehow, that you have there somehow in between a DEX pool with synthetic stablecoins that are backed by two pools of different stablecoins, and that you can also then get the spreads more or less to zero. So we also see this. And I would say euro and US dollar are there the perfect setup for hedging.
Great, thank you. Anybody else wants to add your opinion?
I think both can probably live together, like these kind of hedging derivatives and the local stable coins as well. Both in a case of very early. We actually, for something else, we had to hedge some, I believe, USD exposure, GBP exposure, and looked at doing it through perp dexes. And I think we would have been 30% of the OI at the time, and that was the only way we could do it on chain. So yeah, I actually hope both cases, more use cases or products grow, because yeah, there'll always be, I think, a use case for both products.
Perfect. I think to Max's point, we have to schedule another one of this discussion in a year and see if we were very wrong or very right or in the middle. But well, guys, I just want to thank you all for the time. This is a recording session, so we will share with those who couldn't attend. Thank you so much, Fred. And this was very, very helpful. And again, thank you for joining.
Thanks,
Thanks, everyone.
Have
Thanks,
a good day.
Andrea.
Bye-bye. See you.